Hello traders, Gary Wagner here. It is 11:42 in Honolulu, 5:42 in New York on Monday, first trading day of May 2nd, 2022. And this is the daily report for gold and silver. One day prior to the onset of this month's FOMC meeting, we had gold experience a tremendous, sharp, and deep price decline, giving up $48.50. That is a decline of 2.54%, taking the most active June contract to $1,863.20. Silver declined, but not nearly as strongly as gold, because silver, of course, is not as much of a safe haven asset. Nonetheless, silver futures gave up 40 cents, and an ounce of silver is currently fixed at $22.68.5. This was the result of dollar strength. The dollar once again hitting those tops right at around 103. 103.625 is the closing value of the dollar index. We'll talk about that in detail when we pull up some charts. That's a net gain of 0.64%. And also, Treasury yields and bond yields rose to the highest value since about 2018. Traders, the first chart that we're going to look at today is a weekly chart of the dollar index. The dollar index has been so extremely strong and has put tremendous pressure on gold pricing, including today. The first thing that I believe is noteworthy is the tact or angle that we've seen this recent rise since the first month of 2022. I've drawn an arrow to indicate January 1st. It is almost a straight parabolic rise, but what is more interesting is the fact that we can look at the occurrence of now a triple top in which we have seen the dollar index trade at this level above 103. The first occurrence took place at the end of 2016, the beginning of 2017, and we saw gold decline from that price point to just above 88 over the period of approximately a year and a month. The second occurrence happened in April of 2020, and again, what followed was a deep decline in terms of the dollar index, moving from 103 plus down to, in the case of this move here, 89. Now we are once again at 103 and change, 103.62. We have the absolute top here at 103.73. Does that mean history will repeat itself? I can't answer that, but what I can say is we have to really go back a tremendous amount of time to see any other occurrence of the dollar trading at this particular level. And in fact, as you'll see on our next chart, which is a monthly chart, it has never traded just to 103 and then declined. We have one instance where it traded much higher, and we'll take a look at that chart now. To put recent dollar strength into perspective of the big picture, I've had to go ahead and pull up a monthly chart. What we will look at is what occurred, call it 2003, and put that into perspective. We had the dollar index at 120, quite a distance from this triple top that we've identified in recent data. And the only time we can actually look at the dollar at roughly this particular price point here, we can see the dollar dropping much further below, actually trading to a low below 72. So the fact of the matter is, in that perspective, we can easily say that this current range between 88 and 103 is, on an isolated basis and a enlarged basis, quite significant. In terms of the big picture, we've seen the dollar much higher and much lower, historically speaking, over the last 30 to 40 years. Traders, obviously, today's decline in gold was dramatic. It was severe. However, luckily enough, it did not really affect our trade because we put a very tight stop in above our entry price. We had our stop at 88. We entered at 83. Therefore, we actually pulled $500 per COMEX contract out of the trade rather than sustaining a major price decline and major loss on the trade. We are currently flat with no active trades and will absolutely remain that way as we go into the beginning of the FOMC meeting, which begins tomorrow and concludes on Wednesday. In other words, we want to let the dust settle. However, what are we looking at for potential? In terms of gold, if it continues on its decline, on a technical basis, the first level of any kind of real support, I would say, occurs at 1834, and that's an important level because it's based upon the 200-day moving average. We have clearly broken below both the 100-day and 200-day moving averages. You can see that I have just added those to the screen. The 50-day moving average is well above current pricing, and we broke through the 100-day in trading today, which was at $1,877.90. That means, in terms of the interpretation, in terms of a short and interim view of market sentiment in gold, those have turned bearish, while the long-term view, as long as it remains above the 200-day, can still be looked at as a bullish demeanor on a very long-term basis. That doesn't change the tremendous price decline over the last couple of weeks from $2,003 below $1,900 to current pricing at $1,863. Nonetheless, the first target, if we do see a further decline, is going to be 1834. We're pinning major support at 1820 to 1828, and that is based upon two different retracement levels. One, a Fibonacci retracement, that is the 618% retracement at 1628, and the 50% retracement. 50%, of course, is not a Fibonacci number, but it has been widely regarded as a valuable number for stock traders. So we also put that in when we see two different data sets hitting the same price point. It lends strength, or gives it greater strength in terms of the signal that it presents. So all in all, what I would say is we've got a price band between 1834 and 1820 that should be, if gold continues to trade lower, a level where we could find major support or support kick in and conclude the current correction. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.